Hello, I'm Andrew Keane from Edison. Today we welcome back Ross Driver, Fund Manager at Foresight Solar, which recently released its annual results for FY23, recording high production of over 1 terawatt hour of renewable energy and 120 million of cash distribution. Ross, welcome.
Hi Andrew, great to be with you today.
Let's start with the first issue of the difference between private market transactions and public market transactions. Can you talk to the issue of the way that private markets might be valuing assets versus the way that public companies are reflecting them in their NAV?
Yeah, no, I think it's a very good question. That it's been a question that's been out there for a while because there haven't been that many transactions in the market with, as we've been seeing, clearly the base rate increasing significantly and discount rates increasing as well. So we feel it's been really quite helpful to see these transactions. There was the recent disposal of a large, it was about 0.5 gigawatt, just over, called the Toucan portfolio, which is a portfolio of solar assets that's very similar to the assets that we own, similar rock vintage and background. And that's the pricing that's out there in the market or has been disclosed is about 1.35 million per megawatt. So if that compares really quite favourably to our own valuation, we see as a little bit more conservative. It was private funds that have come into that. They are potentially able to take a view on some other assumptions underlying it. I think it still shows the strength of interest in these subsidy-backed projects. But for comparison, that was 1.35 million. Our valuation assumptions are more conservative. We're at 1.17 million at the moment. So I think it shows that there's a bit of the more prudence that's put into our own concerns. But I think at the same time, as the rates stay higher for a bit longer, we may see even those sort of secondary market transactions moderate a little bit. So I think we're very comfortable with where our valuation stands at the moment.
There's still this quite strange disconnect between private market valuations, sort of looking at a slight premium to the way that people are valuing them, you know, in terms of NAV. But the public market valuing equities at a discount to NAV, that sort of prevents you from raising fresh capital. How do you deal with that strategically?
Yeah, and you're absolutely right. There is a disconnect in the market here between, I think, and speaking to investors, I think they're also acknowledging that these transactions have been helpful to prove value. So I think there's less debate now around whether the discount rates are the right ones. The trouble is getting fresh money into the sector at the moment to help the share price re-rate. I think part of it is also still down to what else investors can look at the moment, what else they can put money into. It's still a very challenging market. And let's say there's a lot that we're doing at the moment and a lot of levers that we're pulling on to try to help address this discount. But there's probably only so much we can do in reality until the base rate starts to come down. And that should be a bit of a driver. We know it's not coming down to the same levels of the last decade, but we would expect it to moderate down a little and then to see there should hopefully be a re-rating in the sector. Although that said, we know it's not going to be business as usual. So there's a few things that we've been doing in terms of our at the year end. Well, there's a lot we're doing in terms of capital allocation that we can come on to in a minute. But specifically, it's another reason why we think it's very important to offer a strong yield. We gave a 6% uplift on the dividend this year for the second year in a row. We're now at a 8 pence dividend target for this year. That's a 33% increase since the fund started over these years. But we're also looking at the ability to give a route through to long-term growth by building out our proprietary pipeline and more investments in assets at the development stage in there as well.
Coming back to that issue of capital allocation, how do you prioritise it? Because you've got cash being generated from the portfolio, you've got cash coming from divestments, you've got debt reduction and growth opportunities. How do you prioritise those?
Yeah, it's a split between them, but actually the two biggest priorities at the moment have been repaying debt. The majority of the debt on the fund, the long-term debt, is all fixed priced and hedged out as well. So we don't have much in terms of interest rate exposure there. As I think it's fair to say, most of the peer group, we all have these revolving credit facilities that in more normal market conditions, we would draw on to buy assets, raise money to repay. That variable rate debt has got higher. Ours is over 6% now for the year. So that is a key focus to pay down. We've been specifically using proceeds from the divestment. So we sold down 50% of our Spanish Lorca portfolio, had 24 million in from that, and that went straight to pay down the RCF, along with free cash generated during the period. But as you rightly say, we've had a very highly cash generative period over the last couple of years, given the good fixes and power prices that we've experienced. So this has also allowed us to offer set a budget of 40 million for a share buyback program. So we see as a buying, given that disconnect that you talked about before, we see buying our own stock, given that disconnect in the price, to be an incredibly good investment and use of money. And it's also offering liquidity back to investors at the time that they've had redemptions too. So both of those are the total priorities, continuing to pay that debt down via divestments for the rest of this year. Also, continuing on with that share buyback program. I think outside of that, we're not looking to put, we're focused on that. We're not looking to put big money into capital allocation. We've paused some of our construction projects at the moment. But the one thing where we've said to investors is we do see that there is benefit in modest amounts of investment is in growing our proprietary development pipeline. So the first example of that is the just under 0.5 gigawatt portfolio of solar projects that we have in Spain. That investment, the initial down payment on that was single-digit million euros as well. And 85% of those payments only come through to the developer once they get those projects to planning consent. So it's minimal payments up front. Then when even those projects get to a consented basis, we know we could sell them straight away into the market at a premium. So this is bringing forward, we're looking to put modest amounts of investment capital to work at the moment to build the pipeline for the future across different markets. But that will be once we've strengthened the balance sheet, pay down things. We're not expecting to make, apart from existing commitments, any additional big capital investments this year. But for the future, the medium term, that is where we're looking for the growth to come through.
In your results, you talked a little bit about shifting to some earlier stage opportunities where the returns are perhaps higher. Can you talk to that as a general strategy, and how heavy will you focus on that area?
Yeah, of course. So what we're talking about is going into development stage assets, working with developers, bringing through pipelines from them. There's a variety of structures we can do on that. So the development pipeline, the 500 megawatts we got in Spain, we actually bought 100% of those rights from the developer. They continue to develop those projects out as a service for us, and they will get their payments when they get through to construction. I mean, there's a broad spectrum of how early stage you go. What we're actually looking at is probably what developers would call mid-stage, because they're actually defined projects, they're sites, they have grid connections, they've just got to go through the formal planning process. And what we're looking to do, because we know that going in at that earlier stage can give you some really good returns once those projects get through and consented. So we put a portfolio approach together, like that's got 6 projects in it. So not necessarily all of them will come to fruition. That's part of the going a bit earlier stage and the risk-adjusted returns out of that. But to give an idea, the first project of that could come through later this year. And even if we just get that one project ever come through from that portfolio, that makes the returns work for us. So we're cross-collateralized on that basis. Of course, that the success rate, given that we've seen, because of Foresight Group, we've been doing this for many years, is we would expect a lot more. That's the first portfolio. We'll be looking to replicate that in different markets in the UK with solar, co-location, maybe a bit of storage in there as well, and other markets, maybe in Spain, other continental European markets as well, to build that pipeline to about 2 to 3 gigawatts and do a similar thing with all of it.
I was going to ask that question actually on geography, because your Australian portfolio was slightly underperforming, and the early stage opportunities are perhaps a little bit more European. Is your geographic mix changing?
The new investments are mainly focused on Europe, absolutely, and sort of core markets, UK, Spain, absolutely core markets for us, potentially a number of other European markets in there as well. Yes, we are managing through the Australian portfolio at the moment. It's a good market for BES. It's not somewhere we're looking to add more at the moment. We're looking to stabilise that and sort that portfolio out.
And coming back to that issue of dividends, so you've grown it by 6% to 8p,
yep,
which is almost 9% yield at the moment, and strongly covered by cash.
Yep.
but also the forward markets are quite volatile and coming down. So
yes.
How do you think about dividend cover in a really volatile power market?
Yeah, and how do we square that circle? It's a very fair question. Analysts have been picking up on it. We've been talking to investors about it for the last few days. So really, what gives us the cover? Ourselves as the manager and the board have always been very focused on making sure that the dividends is sustainable and well covered into the long term. So that is the starting point for any dividend increase year on year, and always has been. The way we've looked at this in this period is, what are we still comfortable to give? We want to pass on some of the benefit of higher inflation and these high power prices we've been seeing to investors. We have uplifted it by an amount last year. I think this is a little bit of a catch-up. I mean, we can't promise it's going to be 6% every year going forward, especially as inflation's coming down, but we wanted to get it up to a good yield now for going forward. And the way that we've been seeing it, we are very well covered in terms of our dividend cover for the next couple of years. And then the power prices are coming back down to their long-term average. Those haven't changed since before the pandemic. The consultants still have the same view on the long-term power prices there. The question is the medium term, so between sort of 26, 27 and 2030. I think the good thing that we can say is the sort of forward rates that we're seeing with the off-takers and the broader pool of off-takers that we work with is still giving us cover that we can fix out all the way up to the end of this, well, close to the end of this decade, at prices that still support a very strong dividend cover for solar that is a pretty stable, less volatile production source as well.
Great. Ross, thank you again for joining us today. For further information relating to Foresight Solar, please see the Edison website for relevant research. Thank you very much for joining us today.